stopped out here again, and stopped out here again. So 1, 2, 3, 4, 5 losing trades, and 1 winning trade. Like I said previously, 5 losses in a row. Can you lose 5 times in a row? Absolutely. There's 5, maybe even more, probably 6. Depending on your rules, maybe even 7. Okay? However, when you're managing a position, let's say you took the trade that I talked about over here, broke out to the upside, and you were thinking to yourself, you know what, I think the market's going to trend, so I want to wait for an hourly bar to close below the moving average or go 15, no, we'll do 20 pips past it. Okay, let me say that again. So if I were thinking that the market was going to move along and it was going to trend, then remember I talked about earlier the if-then statements? So if the market's going to trend, then it should not close below the moving averages. That's my theory. Okay, that's my estimate. So how am I going to trade it then? Well, I don't want to just say it can't close below here, because what happens if it moves down and it closes way down here, like this bar? You know, that was a big break past the moving average. So I can say, well, if it closes below the moving average, or it goes 20 pips past it, or, you know, whatever, you pick your risk. Because, and the thinking there would be, I want to stay in the trend, and I don't want to worry about the market just making these little drawdowns here, these little retracements here. I don't want to be concerned with this. I want to just capture the market move up. But then, you know, if it does close below the moving average, which it did right there, then you know what? I want to get out. Or if it closes below this moving average, then, you know, I want to get out. Now, why? What's the theory behind that? Well, the theory behind that is if the market is moving in a momentum move, there's going to be a big separation between price and the moving average. Okay? There's going to be a big angle here, a steep angle. Let me draw that a little bit differently. So if you just draw a line straight up here, you would see that, look at that, there's a steep angle. Okay? Steep angle between price and the moving average. Okay, whereas if you look over here, price and the moving average are fairly close together. Okay, it's just flat. Let's look at over here. Price, moving average. See that? There's not as steep of an angle. So the thinking goes, well, if price then comes back down to the moving average, what has happened? Momentum has died off. What do we know about liquid markets? Liquid markets don't like going sideways. So if it has stopped going up, what does that mean? It's probably going to go down. So I want to capture my profits. You might want to stop this and rewind and listen to that again and again. Okay? So let's continue on looking at the moving averages. Now what do we see? You know what, let me do this. Now we don't have any bars. Okay, we're just looking at the moving average. So here's price. We know that the high was right about there. What do we see the moving average doing? See how it's curving over now? You see how it's getting closer together? The momentum has died off, hasn't it? It's starting to roll over. Okay? Momentum is dying down. Now, of course, let me put the bars back on. You could put your left finger here and your right finger there and see the same thing, or you could draw some lines on the chart and see the same thing. You could see that the market was starting. Let me draw up some big blue lines on here. You could see this. What is that? Okay, the market is pinching down. Looks like a triangle, doesn't it? Maybe even a pennant. Okay? So the moving averages